asset class returns in February. Alright, in this video what I'm going to do is take you through the asset class returns for February. I'm going to talk through the winners and losers, the drivers, and a couple of thoughts on the next steps from here. So let's look at the tables first. So we've got the month on month here. These are total returns USD unhedged, and that's basically lining up with the capital market assumptions that I run. So yeah, the winners were Treasuries, basically some of these sort of safe haven assets here, I guess you could call them. Treasuries, they were the outstanding performer of the year, better than sovereign actually, global sovereign, which is actually quite an interesting side note. Really, is that you saw Treasuries actually quite significantly outperform some of the other bond yields. Like Treasuries actually went to new lows. Some of the other government bond yields did not actually make it back to the lows, which is quite an interesting point actually in passing. Elsewhere, you got investment grade credit, and compare and contrast investment grade credit with US high yield credit, where the duration kicker did not offset the adverse impact from the risk aspect there. The other thing to note there, just in passing too, is high yield credit tends to be of a shorter duration. So that can be a good thing or a bad thing. If interest rates were to surge, then investment grade credit would come off disproportionately. But if interest rates were to fall very sharply like they did, then you see the longer duration investment grade credit getting more of a kick there. And then basically anything bond related that didn't have some sort of deeper risks tied to it. So EM sovereign credit, EM sovereign bonds, both in hard dollar and local currency, neither of them performed very well. And then anything that was like equities or real estate or infrastructure, commodities, emerging markets, frontier markets, EMLPs in particular, everything else just got hammered, and mostly in the last week of the month. And so a couple of stats for you there. So the S&P 500, it actually rose just over 5% in the first 3 weeks of the month, but then it fell 15.8% from top to bottom, that is a definite definition of a correction. That is a full-on correction, that, and then only ended up down minus 8.4% for the month. And then of course we had a big bounce overnight. And then treasuries, the 10-year treasury yield, they started the month at 1.51%, reached a high of 1.68 before closing at 1.16, and 1% was looking very close in reach, but that has that's sort of turned around, and I'll get onto that in a second. But what were the drivers? What actually caused this? Well, obviously the big catalyst was the virus news headlines was kind of becoming worse than expected. But there was a few other things going on, like the data pulse had been kind of lackluster, especially the hard data. And the other thing is Sanders, had become pretty obvious that he was the front runner for the Democratic presidential nomination. We'll see how that kind of pans out this week, because that'll swing the other way perhaps, or swing even further in his favour. Obviously Sanders is very much left-leaning, and a lot of his policies are, sure, they might be good for a certain cohort of people, but they're probably going to be bad for stocks. And then the other really important thing that probably wasn't highlighted enough, I was definitely talking about, was just how there was a few technical signs, certainly in the back end of the third week there in February, that for example, bearish divergence in the S&P 500 against its RSI and market breadth, and that resolved clearly to the bearish side. So what to expect next? Well, first with the technicals. Technicals went fully oversold, and now we have had that bounce. So really it's what happens after the rebound. Well, the big thing is basically going to be happening within the next 24 hours, and that is the G7 coordinated stimulus phone call. This is it's going to be a very interesting thing. It could be one of those events that we look back on for years and point to as the turning point, the thing that really put things back on track, or it could be, a massive disappointment. We'll have to wait and see. It's going to come out. We'll find out what's happened from that just before the US markets open on Tuesday. And yeah, basically it's the G7 finance ministers and central bankers. They're going to get together and figure out what to do. And yeah, virus, obviously there's the constant news flow with that. Data, there's the ups and downs there. Probably going to get worse before it gets better. And then of course US politics, we've got the Super Tuesday coming right up. So it's going to be, in terms of the outlook, I prefer to look more medium term. I prefer to look, in terms of months and years. But a lot's going to happen in these next couple of days in terms of the next steps. But look, if you're after more updates or you want to talk more deeper about this or have a look at some more charts, just go through to the website.